Good morning, everyone. Thank you for joining our webinar. Today we'll be talking about the IC DISC, Permanent Tax Savings for Export Activity.
Thank you for attending our webinar on the IC DISC Export Incentive. Just a very brief background on my firm. I'm with KBKG, which is a firm that was established in 1999 in Pasadena, California, and our firm provides turnkey tax solutions to tax professionals and businesses. That includes the research and development tax credit, cost segregation studies, energy tax incentives, repair versus capitalization studies, and of course the IC DISC export incentive. We've performed thousands of tax projects and saved our clients millions of dollars. Our team is a diverse mix of tax specialists, which include attorneys, energy consultants, CPAs, engineers, and professionals from various disciplines. And by combining this talent, it allows us to focus on our areas of service and maximize the tax savings for our clients. And we like to view ourselves as a preferred provider of thousands of CPAs across the country. A little about myself. I'm the practice leader for KBKG's Export Incentives practice. And you might have heard me on some of our other webinars. I do the one on tangible property regulations as well. I have 15 years of tax and accounting experience, 10 of which were with the Big Four. And I have extensive experience with international tax. I have an accounting degree from Ohio State University, and I'm also a CPA. So if there are any fellow CPA or fellow Buckeyes, feel free to hit me up through the chat. I'm also a licensed attorney, having graduated from the Tulane School of Law in New Orleans. And I have an MBA from the University of Minnesota. And then finally, I'm a member of the American Society of Cost Segregation Professionals. So I'm going to start out by giving an overview of the IC DISC export incentive. So let's start out with what IC DISC means. It stands for Interest Charged Domestic International Sales Corporation. And of course, that's quite a mouthful, so we're just going to refer to it as IC DISC throughout. It was originally intended as a way to defer income, and there was a nominal interest charge for that. But now the incentive is used to primarily generate permanent tax savings. These rules are part of the tax code, similar to the research and development tax credit and the energy efficiency incentives and charitable giving and the home mortgage incentive. This incentive was designed to spur behavior by taxpayers. Here in particular, it's designed to help U.S. businesses compete internationally. Another thing to note about this incentive, it's not like an offshore holding company in the Bahamas or the Cayman Islands or something like that. It's not a tax scheme. Again, this is very much part of the Internal Revenue Code. Our Congress wants people to take advantage of it. However, many taxpayers who would qualify for this incentive, they're just not utilizing it, or even if they do have an IC DISC in place, they're not capturing all the available, intended, and allowable benefits. So what is the IC DISC? It's the sole surviving tax incentive created by our Congress to facilitate export of U.S.-made goods and services. Note that I'm saying services because certain services apply. There are a number of misconceptions on this incentive that we're going to try to clarify in this presentation, one of which is that it's only for manufactured goods. It was, as I said, originally created as a deferral mechanism, but in 2003, the IC-DISC began to provide permanent tax savings for closely held flow-through companies via the qualified dividend rate, where the dividend rate was 15% from 2003 through 2012. Now the top dividend rate is 20%. And closely held C corporations, they're able to enjoy permanent savings as far back as 1984. So at least 50%, half of taxable income, or 4% of gross receipts, which is limited to taxable income from products made in the U.S. and used outside the U.S. are taxed at a 20% rate rather than a 39.6% rate. So basically what this incentive does is it creates a tax rate arbitrage. Rather than being taxed at ordinary income tax rates, you get taxed at the capital gain rates. And there's some ways to actually increase the amount of the commission beyond what we have in this paragraph, which we'll discuss later. We have a number of slides that have flowcharts and spreadsheets that help show how this benefit is calculated. So bear with us. So very briefly, we'll talk about the history of export incentives. So between 1971 through 1984, we had the DISC regime. From 84 through 1999, we had the DISC regime. And then after that, from 2000 through 2006, we had the ETI exclusion. All these export incentives were put into place by Congress, but they were all eventually repealed due to pressure from our trade partners, from the U.S. GATT, from the European Union, from the World Trade Organization. They put pressure on the U.S. to repeal these incentives because they viewed them as unfair trade subsidies. However, the IC-DISC, that has not been challenged to date. And part of the reason why is this incentive only applies to private companies. It doesn't apply to public companies. So for example, Airbus, which is a European manufacturer of airplanes, they're not going to raise a red flag about this incentive because of Boeing has taken advantage of it, because Boeing is a large publicly traded company here in the U.S., and they can't take advantage of it. Again, this only applies to privately traded companies. So again, it's because it only applies to privately held companies, it's escaped under the radar. And again, to date, this hasn't been challenged. So continuing on, what is the IC-DISC? Well, first it requires the setup of a separate corporation, a new entity, and then that new entity elects treatment as an IC-DISC. That entity can be paid a deductible commission by the operating company based on export or sales income. The dividends are then paid back to the parent, and those are taxed at a 20% rate. And then, of course, the 3.8% ACA tax rate, that generally applies. This new entity then files a separate return. It's the 1120 IC-DISC. There's no change in business operations needed. The IC-DISC entity is more of a paper company that's there to facilitate this incentive. Not much more to that. We've got the typical structure on the following slides that illustrates how this incentive works. So this is the original use structure. If you recall from my earlier slides, I said that the IC-DISC was initially set up as a deferral mechanism of income. And here's how it worked. We had the corporate or individual owners that owned a U.S. operating company, and that U.S. operating company would be taxed at ordinary tax rates. They would pay down a commission, which would be deductible by the U.S. operating company. That commission would be paid to the IC DISC, which is generally a tax-exempt entity, and then that IC DISC would loan that money back up to the U.S. operating company. So that commission paid down by the U.S. operating company, that's going to offset ordinary income tax. The money that they paid is going to come back in the form of a loan, and there's going to be a nominal interest charge to that. But again, it defers income. The operating company still has use of the funds because it's loaned back to it by the IC DISC, and of course they have to pay a minor charge for that. But again, the commissions are offsetting ordinary income, so it does create that deferral. Now, because we've got a difference in the capital gain rate, the dividend rate, we have a permanent tax savings. So this is a typical structure for a flow-through entity, a partnership, an LLC, an S-Corp, for example, where we've got the corporate or individual owners, and they own the U.S. operating company. That operating company is going to be taxed at a top rate of 39.6%. They're going to be paying a commission down to the IC DISC, which again, the IC DISC is a tax-exempt entity. That dividend is going to be paid up to the U.S. operating company, but that dividend is only going to be taxed at a 23.8% rate, which includes the ACA rate. So you have this permanent tax savings between the 39.6% and that 23.8%. And that's where you get the benefit of having an IC DISC. For a closely held C Corp, the structure is slightly different. Rather than have a parent-subsidiary relationship between the operating company and the IC DISC, you have a brother-sister relationship. So you've got the individual owners, and they own both the U.S. operating company and they own the IC DISC. The U.S. operating company, they're going to be taxed at ordinary rates, but they're going to be paying a commission to the IC DISC, which is going to offset the income made by the U.S. operating company. The IC DISC, again, they're not going to pay any tax because generally they're a tax-exempt entity. The IC DISC is then going to pay the dividend back up to the individual owners. The dividend to the individual owners is going to be at that 23.8% rate, which again, the 20% dividend rate, the 3.8% ACA rate. So, in effect, we have this tax rate arbitrage, which again, that's going to create the permanent savings. We've got these sheets that illustrate the basic benefit for a closely held flow-through corporation. So, here in the first column, we have a situation where we don't have the IC DISC set up. So, the company is earning $5 million of export sales with a 20% net margin. So their net profit is going to be $1 million. Their taxable income is going to be $1 million. So they're going to be taxed at a 39.6% rate. So the total tax is going to be $396,000 in the situation without the IC DISC. If we do have an IC DISC, though, we have the same $5 million of export sales, the same 20% net margin, and the same $1 million of net profit, but we have the deductible IC DISC commission, which is going to be 50% of the net profit. So they'll be able to deduct that. So the taxable income is only going to be $500,000 as opposed to $1 million without the IC DISC. That $500,000 is going to be taxed at the same 39.6% rate. So we're going to have $198,000 of tax at the partner level. there's going to be a dividend to the shareholder, and that's going to be taxed at a 20% rate. So the shareholder level taxation is going to be $100,000. So the total tax with the IC DISC is $298,000. So if you look at the bottom numbers, without an IC DISC, you've got $396,000 of tax. With the IC DISC, you only have $298,000. So the net savings is $98,000. And again, this is a permanent tax savings, and this is something that companies can benefit from year after year. For closely held C corporations, the benefits can even be larger. So in the first column, we've got the situation where we don't have an IC DISC. So we've got $5 million of export sales with a 20% net margin and $1 million of profits. So we've got that $1 million of taxable income that's going to be taxed at a 35% corporate rate. So the corporate level tax is going to be $350,000. The rest, the remaining $650,000, is going to be dividend up to the shareholder, and that's going to be taxed at 20%. So the shareholder level taxation is going to be $130,000. So we're going to have total tax of $480,000, the $350,000 of tax at the corporate level, plus $130,000 of tax at the shareholder level. In the middle column, let's say we do have the IC DISC, so we have the same $1 million in net profit, but we're going to have an offset to that of $500,000. That's going to be the commission paid to the IC DISC, which, again, that's going to offset the profits. So we're going to have $500,000 of taxable income left, which would get taxed at the same 35% rate. So the corporate level taxation is going to be $175,000. There's going to be a larger dividend paid to the shareholders, and that's going to be taxed at a 20% rate. So the shareholder level taxation is going to go up to $165,000. But if you look at the total tax, it's $340,000 with the IC DISC versus $480,000 without. So in this hypothetical, we're going to have a permanent tax savings of $140,000. So we're going to briefly talk about the legislative backdrop and outlook for the IC DISC. So the IC DISC was challenged in a proposed Tax Technical Corrections Act in 2008, but there was a groundswell of support from a bipartisan Senate consortium, and the IC DISC benefactors successfully lobbied to have the IC DISC preserved as a very worthwhile incentive for U.S. production and export of U.S. products and services. Since then, there hasn't been any proposed tax technical corrections. It was also challenged with the qualified dividend rate, where initially the qualified dividend rate was going to go away and go back to the ordinary tax rates, but that was reestablished back in 2013 at a 20% rate during the fiscal cliff negotiation. So again, without having a lower dividend rate, the IC DISC could only be used as a deferral mechanism, but because we have this difference in tax rates, the IC DISC can create those permanent tax savings, and it's created a renewed interest in this incentive. All right, so let's talk about what products or services qualify for the IC DISC. Well, they could be exported goods, and these could be goods that are directly or indirectly exported, and it includes Canada and Mexico. Quite often, when we're talking with potential clients, potential beneficiaries of this incentive, we might get a response that say, we don't do any export. Everything that we sell remains here in North America. Well, shipping to Canada and selling to Mexico, that certainly qualifies. We also have the word indirectly italicized. So if you sell your product to a distributor and that distributor then sells the product outside the country, that would also qualify as well. Not only would it qualify for the manufacturer or the producer, but the distributor might be able to take benefits under the IC DISC. There's a requirement for U.S. content where no more than 50% of the sales price can be foreign content. This is very easy to meet, where you can meet it just purely by marking up the product. So again, it's 50% of the sales price. So if you mark up the sales price, you're going to meet this test. There's another requirement for U.S. manufactured goods where 20% of the cost of goods sold must be from U.S. labor and burden. The products must not be further manufactured within the U.S. by another party. What that means is, let's say you manufacture transmissions, and those transmissions get installed into a tractor, and there's a further manufacturing of that. And then that tractor gets shipped overseas. That's not going to qualify because there's further manufacturer in the United States. The company that manufactures the tractors might be able to take advantage of the IC DISC because they're the exporters, but the company that manufactures the tractors would not be able to. Note, however, that further manufacture outside the United States, that's okay. So if we have a U.S. manufacturer and they manufacture the transmission and then they ship it into Mexico, and in Mexico they install it into a tractor, that's totally fine. But again, you can't have further manufacture within the U.S. And then certain services apply. These are primarily architectural and engineering services. So if you're doing design work on a building or on a structure or something like that, that could qualify. And leases qualify as well. If you have U.S. products that you're leasing abroad, that, again, could qualify. One question that we often get, since we're tax professionals, is, hey, if I do a tax return for someone in Canada or someone in Mexico or somewhere overseas, can that qualify? Unfortunately not. Again, it relates primarily to architectural and engineering services. There are several frequently missed opportunities with the IC DISC. So for example, ultimate use sales. An example would be, let's say I manufacture a product and I sell to the U.S. military. Well, the U.S. military is a U.S.-based organization, of course. So you might think, I'm not exporting anything, but if the ultimate use of what you're selling is used overseas, that's going to qualify. We had a client that manufactured water purifiers, and they would sell to the military. And they didn't think that the IC DISC would apply to them because, again, it's the U.S. military. They're here in this country. But here in the U.S., we've got good access to water. It was overseas where these water purifiers were needed, and the U.S. military would send them into Europe and into Africa and into Asia and other locations like that. That qualifies. even though they're being sold to a U.S.-based organization, since the ultimate use is overseas, that's going to qualify. Sales to related parties can qualify. Detailed transactional calculations. There are different ways to calculate the amount of the commission that gets paid from the operating company to the IC DISC entity. We're going to cover some of those more detailed methods later on, but usually some people think that you're limited to 50% of taxable income or 4% of gross receipts is the maximum amount of the commission that's paid from the operating company to the IC DISC. But no, there are actually more advanced methods available at 50% of taxable income or 4% of gross receipts. That's akin to taking a standard deduction when an itemized deduction would yield better results for an individual taxpayer. Very similar situation here where there are more advanced ways to calculate the amount of the DISC commission, and of course the higher the DISC commission, the more permanent tax savings you're going to generate with this tax planning opportunity. Another frequently missed opportunities is distributor sales. This works in two ways. One is if you're a U.S. manufacturer and you're selling to a distributor, let's say on the Texas-Mexican border, if that distributor then ships those goods into Mexico or they send them elsewhere outside the country, that's going to qualify not only for the manufacturer, but the distributor would be eligible to take advantage of the IC DISC. And then finally, services. As I mentioned earlier, people don't think that service is qualified. Most people think that this incentive is only applicable to manufactured goods, but again, architectural services apply, engineering services apply, leased products applies. We had a situation where an architectural firm was tasked to design a Ferrari-themed theme park in Saudi Arabia. And even though the theme park was never built, that qualified. They're doing design work overseas for a project overseas, and they were able to take advantage of this. So if you're a tax professional and you service clients that provide architectural and engineering services abroad, certainly make sure you consider this incentive. There's some misconceptions with this incentive. One is the $10 million maximum export sale. If you're using the IC DISC as a deferral mechanism, the most that you could defer was this $10 million of maximum export sales. But again, that only applies if you want to use this incentive as a deferral mechanism. If you use it to generate permanent tax savings and take advantage of the difference between ordinary income rates and dividend rates, the sky's the limit. You could have $100 million of export sales or $1 billion. Another requirement, another misconception is that the taxpayer must manufacture the products. Again, that's not true. If you're a distributor and you're receiving these goods and you're shipping them abroad, that qualifies. Other people think that it might be an aggressive or an abusive tax shelter. But again, that's totally not correct. This is an incentive that's in our tax code. Our Congress wants people to take advantage of it. It's there. And if you've got a company that can take advantage of it, they very well should. Another misconception is that business operations are disruptive or there's a huge administrative burden in having an IC DISC. And again, that's also false. The administrative burdens are nominal for this. You do need to do the initial setup of the IC DISC entity, and there are some elections and so forth that need to be made. But once it's set up, the administrative burden is pretty nominal, where what it takes to calculate the IC DISC commission, we're just taking standard information that most companies have readily available. Once it's set up, it only takes a few hours a year to keep this thing running. And then business operations too. There's really no change in business operations. You don't need to change your forms. You don't need to change your contracts or anything like that. Everything stays how it was. Another misconception is that 4% of export sales or 50% of export profit is the maximum commission amount. And again, this is untrue. As I stated earlier, view this as taking a standard deduction when an itemized deduction would yield much higher results. And we've got some slides coming up that discusses and illustrates how these more advanced methods to calculate the commission work. Another misconception is that quarterly commission calculations are required. There's some other firms out there that say that this is necessary, but that's totally not true. Quarterly commission calculations, those are not required. And then one final misconception is that the IC DISC benefits for foreign owners is endorsed by the tax code. That's not true. If you have a business that has foreign owners in it, that's something that we would want to discuss with you as far as whether it makes sense to do an IC DISC or not. There's several benefits of doing a detailed IC DISC analysis. Some of them are identification of additional eligible sales. When we do these studies, quite often we find that what people think is the definition of export really doesn't match up with what the tax code allows as an export. And quite often, eligible sales are missed. So there is a benefit of doing a very detailed IC DISC analysis. Another one is the allocation and apportionment of expenses, where we want to make sure that these are done correctly and you're taking advantage of all the rules that are available. Another benefit is the transactional calculation with marginal costing. And as I said, there are more advanced ways to calculate the amount of the commission. We're going to cover those in subsequent slides, but this is one of them. And then finally, redetermination of prior year calculations. I know when we look at taxpayers that have IC DISCs set up, quite often they're not including everything that they can to maximize the amount of the commission. And the tax code allows a redetermination of prior year calculations. Quite often we've come back with clients who've had an existing IC DISC. We've reviewed the information provided and we can come up with a calculation that's significantly better, significantly higher than what the taxpayer originally took. So keep that in mind. So as far as identification of eligible sales, typically manufacturers, processors, distributors, and growers with over $10 million in sales are potential beneficiaries of the IC DISC incentive, even if only a small percentage of their products are used outside the U.S. So we do recommend if you are a tax professional, you've got clients that have $10 million in sales, it's probably worthwhile having a conversation to see how much they export and determine whether it makes sense to do an IC DISC. We have a number of these conversations every week with people. Sometimes it works, sometimes it doesn't, but we're always glad to have these conversations, usually within 15 or 20 minutes of talking with someone who knows about the financial attributes of a company and their activities. We can pretty quickly determine whether they make a good candidate for this incentive. All manufacturing, growing, distribution, extraction, and architectural engineering firms should be thoroughly examined, even if they do not think of themselves as manufacturers or exporters. Again, there's a lot of missed opportunity that we find. So taxpayers, people in these industries, they really should be thoroughly examined to see if this is a good incentive. And then export sales or net income at the company level is not necessarily a delimiter for the IC DISC for closely held companies. So even if the company is not paying tax at a very high rate, there still might be some benefit to having an IC DISC. There are a number of overlooked industries for the IC DISC. Software companies, for example. A lot of people don't think of software companies as qualifying, but they do. When these rules were set up, software wasn't a very big thing, and the rules didn't mention anything about software companies. But the IRS came back with their IC DISC Audit Techniques Guide, which is a guide that they provide their field auditors to review when they run into an IC DISC situation. And it says that software is allowed. So that kind of shows the direction that the IRS is heading. Distributors and brokers, that's another frequently missed opportunity where, again, if they're taking U.S. produced goods and selling them abroad, they would be able to take advantage of the IC DISC benefits. So even if they don't manufacture anything, if they're exporting, they'd be able to take advantage of it. Food growers, if you're growing tomatoes in Texas and shipping them off into Canada, or growing peaches in Georgia and sending them overseas, that all qualifies. Food processors as well. We've had one client that manufactured pies here in Ohio, and then they would ship them off into Canada. That certainly would qualify. Equipment leasing. So if you have a bunch of equipment that's manufactured here in the U.S. and you're leasing them overseas, that could qualify. Our recyclers, they also qualify. We've had a number of scrap metal recyclers take advantage of the IC DISC. Similarly, we had one company very recently that would take old carpeting and they would grind up the old carpeting and remove the synthetic materials, and then they would sell those materials into China. That would qualify. And then finally, as I mentioned before, architectural and engineering services. That's an often overlooked industry where if they're a U.S.-based firm in Seattle and they're designing something in Canada, that would qualify. All right, continuing on with the benefits of a detailed IC DISC analysis. As I said, there are different ways you can calculate the amount of the commission, where you can do a transactional analysis rather than looking at the profits made on everything that were sold. You can go through and look at the profits made at a transactional level rather than an aggregate level, and you can significantly increase the benefit. On our end, when we have a study, we've got a very sophisticated calculation engine, a software package that can maximize the tax savings by dramatically increasing the IC DISC benefit using these intended, allowable, and complex methods in the regulations. So again, the regulations, they provide different ways to maximize the amount of the commission, and having a software package that can look at each transaction in detail can maximize the amount of the IC DISC commission. We've had it even double it before. Public companies, they routinely enjoyed significant increases in their export incentive calculation from these detailed analyses using the calculation engine. Now we can increase the benefits to closely held corporations through the IC DISC using these calculation engines. So keep that in mind. Loss exclusion. So if you're looking at it, if you're looking at all the transactions and you're trying to calculate the amount of the commission, you might have some transactions in there that are generating losses. But these losses, they can be excluded. So you're deriving the benefit from the profitable transactions. So if you've got some transactions that are not making any profits from you, you can exclude them so they're not dragging down the profits made on the other items. And that way you can maximize the amount of the commission. Continuing on with another advanced method of calculating the amount of DISC commission is marginal costing. So in conjunction with transactional costing, marginal costing is an element of the IC DISC regulations that allows the less profitable transactions to derive the IC DISC benefit largely as if they were as profitable as an average transaction. So if you have some variability in the products that you sell and the profits that you make on them, marginal costing allows you to look at the less profitable items and swap out the profits with an average amount. Marginal costing can be applied at a transactional level, a product line level, and so forth. Again, using highly sophisticated software, you can optimize the marginal costing benefits in conjunction with loss optimization. So using these advanced methods to calculate the IC DISC commission, you can generate a much higher amount of commission, which ultimately is going to increase the benefit of the IC DISC. We've got a marginal costing example here. So here we've got some pens where the first line is pens that were exported, and then the second line are pens that are domestic. The cost of goods sold for the export pens is 80. It's higher than the domestic, which is only 75. So you've got higher profits for the export pens, and then you've got expenses. They're going to be higher for the export pens, so your net income is going to be less for the export pens than it is for the domestic ones. So if you use one of the basic methods to calculate your DISC commission, if you take 4% of sales, well, 4% of 100 is going to be $4. If you take 50% of the net income, well, 50% of the 8 is $4. But if you use the marginal costing method, you're going to get 7. Again, using these more advanced methods, you're going to get better results, a higher commission, and more tax savings. As I said earlier, you could look at products by different product lines, product groups. You could look at all products in the aggregate to determine what your highest amount of the commission is going to be. These things, they're usually easily constructed from existing data. So we're kind of wrapping up our presentation here. So just to provide a summary of the benefits of doing a detailed IC DISC analysis, proper care must be taken to ensure that the IC DISC entity is properly set up, that the required elections are made, that the shareholder agreements are properly drafted between the IC DISC and the related supplier. There's some basic maintenance of the entity, which requires estimates of the IC DISC commission and the preparation of all compliance documents. It's basically the Form 1120 IC DISC, and then there's a Schedule P. These are the reoccurring activities, but again, it's critical to make sure that the IC DISC is properly set up, the agreements are properly drafted, the election is timely made, and so forth. In conjunction with proper guidance from specialists, the initial and the reoccurring administrative activities usually only cost companies a few hours per year. As I said, the administrative burdens of having an IC DISC, they're not that great. Again, it's only a few hours per year. The information that you need to calculate the IC DISC commission, that usually exists and is very easily obtainable from sales and cost systems. And also note that redeterminations are allowed for prior years from the date of the DISC's inception. So for taxpayers that do have an existing IC DISC, there's still opportunity to go back and do a redetermination to see if you can uncover any additional benefit there. If you have any questions on this presentation, if you want to talk through a specific taxpayer and see if they would be suitable for this, feel free to reach out to me. I'm very easy to find on the internet, or reach out to any representative from KBKG. I'm going to turn it over to you, Ivan.
If you want to join more webinars from KBKG, you can do so by going to kbkg.com/webinars. We have a full class schedule there that you can look and register for. Thank you.
All right. Ivan, thank you. I wanted to thank you for attending our webinar. We've got several others on various tax planning subjects, including the research and development tax credit, cost segregations, of course the tangible property regulations, which is the one that I do, and several others. Again, if you've got questions on the IC DISC, if you want to talk through anything, feel free. We're very easy to talk to, and we can go through and usually very quickly determine if an IC DISC makes sense. Again, thank you for participating.